Hey, folks, thanks for joining us in this video. I'm your co-host today. I'm Rick Swope with the investor education team here at E-Trade for Morgan Stanley. And joining me in this conversation is Ken Keating, who's an associate principal with the OCC and an instructor with the Options Industry Council. And we're going to invite you to an event on March 8th. At the end of this video, you'll see a link that you can join us for that. But we really wanted to kind of give you a fun background on options, on some of the history of trading. When you get into options trading or when you get into trading, sometimes it can seem very sanitized and it's just a bunch of numbers. But the fact of the matter is there's an interesting story behind this. So, Ken, thanks for joining me today. I think we got some fun stuff to talk about.
Yeah, absolutely, Rick. Thank you for having me. And I always enjoy talking about the markets and the market history. And even before coming to OCC, I was a professional trader for well over 25 years as a market maker trading options. So, the markets. I love the markets. They fascinate me, and I certainly love the history. So,
outstanding. Well, Ken, what we'll do today is kind of give people a walk through time, I guess. I don't think people really understand how far back some of these, call them trading strategies, go. And I'm going to start today with, we'll see how the name goes. I'm going to say Tales of Miletus. That's Thales. How many of you have heard about the olive press monopoly? Let me give you a quick story here. This will be our starting point for today. So this fellow was a philosopher, and we're back here in the days of the Greek philosophers. And people thought that philosophy wasn't really the way to make money. It was just kind of a side thing. Well, anyways, this fella, Tales of Miletus, figured that he could tell from his understanding of the stars when the next crop of olives would be good or not. And here's what he did. He, while it was still winter, if it looked like a good olive crop was coming up, he would take some of his money and he'd put deposits on all of the olive presses. And that way he had them locked down for the pressing season. And sure enough, a good olive crop came along. The presses were in high demand. And this philosopher had secured the rights to the presses with just a little bit of money. Now, Ken, we look at this today, and this is exactly leverage, is it not?
Absolutely. Yeah. I mean, it's kind of like an early example of trying to corner the market, really. And this gentleman literally was trying to corner the olive oil press market and having those rights when demand skyrocketed to sell at a higher price than he would purchase them for. So absolutely.
I guess in a way we could kind of call it the first call option of sorts. He paid a little bit of money and got rights, and then when he exercised those rights, turns out philosophers had something going after all.
Absolutely.
Well, Ken, we fast forward then a couple hundred years, and it takes us to something called the Dojima Rice Exchange, which is, I guess, where traders kind of think of where things first started. You want to give a little bit of thoughts and history there?
Absolutely. So the Dojima Rice Exchange, so this was in Japan during the Edo period, which lasted basically from 1603 through 1887. And essentially the feudal domains collected rice as a tax. And many of the warehouses that stored this rice were essentially located in Osaka, Japan. And they would sell the rice to rice brokers through what were known at the time as rice auctions. So these securities developed called rice bills, and these bills were issued in exchange for the rice and were actively traded. So in the early 1700s, an actual spot market developed to trade these rice bills. And then eventually a futures market was developed, and it was authorized by the Edo shogunate in Dojima. And this was what was known as the Dojima Rice Exchange. And it's really, it's the Chicago Board of Trade, which most of us know, the CBOT, which is the oldest commodity exchange in the U.S., which was started in 1848 as a cash market for grain, is said to have been developed based on the Osaka Dojima rice exchange.
I bet
It's
a lot of people don't think that their trading structure, call it, goes back to the 1700s. And you know what's interesting is a lot of folks that do technical analysis might recognize that rice prices is actually how kind of the origins of candlestick charting, which, by the way, is one of my favorite charting styles.
Ah, okay.
Here's a couple of terms that until I really started digging, I wasn't aware of this. Apparently, during the Dojima rice exchange, there was a wooden box that had a fuse cord that was hung at the exchange, and the exchange officials would put a fire on the cord, and trading would continue as long as the box was on fire. Now, the price at the moment, this is crazy, the price at the moment the fire went out became the day's official closing price, known as the fuse cord price. But traders being traders, they didn't want to stop trading. And so what happened after the fuse cord price is these people called watermen would come in and they'd take buckets of water and splash water out to put all the fires out. And then trading stopped. And you know what that price was called? The bucket price. So if you ever hear the term the fuse cord price and the bucket price, that's where that comes from.
Interesting.
Well,
I wonder if there's any history there with bucket shops and
I wondered. Yeah, that's true because in the early 1900s, right, we had Jesse Livermore in the bucket shop. So
yeah,
may very well have been coming from that as well.
Yeah, that's interesting. Very
so, Ken, you and I now, we've probably both of us have been in the markets enough to have seen a few bubbles. And in fact, we could probably look around us and maybe see some evidence of bubbles around us today. But you want to give us a little background on where the real big bubble started with the Dutch tulips?
Yeah, so the tulip mania, the tulip bubble story, which was around 1634, which swept through Holland. Usually this is the story that most people kind of equate to bubbles. And, at the time, there was a huge demand, like tulips had, they held a large amount of status for people who obtained them. And that by 1636, there was so much demand for tulips that you could, the Amsterdam Exchange allowed trading in these products. So at the height, even the best bulbs were going for the equivalent of $750,000 in today's dollars. The equivalent
for a single bulb,
which is crazy. Which is, it's a flower. It's got a finite life. It's kind of like an option, right? But at some point, it's not going to, like gold or diamonds or whatever, they're going to stay in their state for pretty much ever. But a tulip has
how pretty can a tulip really be? Is it $750,000 pretty?
Yeah, exactly right. But as all markets are, due to supply and demand, people flock to them, and a lot of people, now we hear about fear of missing out, FOMO. They didn't want to miss out. So a lot of people started dabbling in these markets, and a lot of people made a lot of money, but they also lost a lot of money. So people leveraged themselves using margin derivatives at the time to buy more than they could afford. So once again, leverage, but leverage is a double-edged sword. So leverage, can be really great when you're on the right side of it, but it can be really horrible when you're on the wrong side of it. And I can tell you personally, being a trader for well over 25 years, I was on both sides, and it's being on the wrong side is no fun. So and then so by February of 1637, the prices of tulips kind of they began to fall, and they never looked back. And by 1638, they were all back to normal. So this kind of reminds me, the bubble that I'm most familiar with, and the most I wouldn't say the most recent bubble, but the one I'm familiar with was the dot-com bubble, which I know you're
Oh
familiar
yeah.
with. And because I started out trading on the floors of the Pacifico Stock Exchange, I moved to the SIBO in the mid 90s. So I was there for the
Mm,
pre-bubble, which was 1995 to 1997.
right.
Real bubble didn't really kind of take effect until 1998 to 2000. And obviously, there were low rates at the time, and because of the low rates, there was a huge amount of capital investment into anything.com. So all these startups, if you put your .com at the end of your company name, you attracted a ton of money.
Oh
And
yeah. Yeah, we remember
yeah,
that.
yeah, and it was just like, the sky was the limit on a lot of these companies. But, obviously there was a lot of companies that didn't survive. The biggest failure, I guess, is not to single them out, but pets.com, which at the time was a great
Yeah.
idea. But they burned through too much capital. They went through something like $147 million in the first 9 months.
They were
So
losing money, but they were making it up in volume, right?
exactly,
That
right.
was kind of the word back in the dot-com
Yeah,
bubble.
and I remember this period. It's interesting because I'll never forget this because I remember a good friend of mine, her mother. We were having dinner one night, and she was considering quitting her full-time job to day trade. And
Ah,
I, and
yes.
I, and I just at that point I was like, no. And she made a little money, dabbling in these stocks. Probably thought she was a genius. Um, Luckily, she never did quit her day job to trade professionally. But that was kind of the
But
top. That's when I knew
that
like this gotten ridiculous. Yeah.
that is kind of the cycle of psychology when people are in the markets. I remember reading about during the Dutch tulip frenzy that so many people were buying on credit. They were mortgaging homes, so to speak,
Right.
and people were forced to sell and declare bankruptcy. But the thing about it was the dealers, the exchange, so to speak, they were refusing to honor contracts when the prices were crashing, and people were left really holding the bag. And what's interesting is, in a sense, you talk about being on the floor, but in a sense, I kind of got my start in sort of the same way. Just a little bit of history here.
Mm-hmm.
After the Black Monday crash in the '80s, NASDAQ instituted a system called the SOS system, small order execution system.
Mm-hmm.
And there was a cottage industry that sprung up around that, and they were called SOS bandits.
I remember
And
that
and
well.
Ken, I know you remember because the SOS bandits were on the other side of your trading, right?
Yeah.
But the SOS system basically, because during that market crash, brokers weren't answering phones, clients had no way to get in touch to make trades, and so NASDAQ said, okay, we're going to give you the ability to buy and sell up to 1,000 orders at National Best Bid and Offer, the NBBO.
Yeah. Mm-hmm.
And what's interesting is out of that chaos grew what we know today is online trading. And in fact, we're here speaking from E-Trade from Morgan Stanley. In '92, E-Trade launched as the pioneering online brokerage service. And and what that did was it really gave the average trader access into this kind of behind the curtains market that they didn't have access to before. And and you talked a moment ago about the CBOT, but 1973 we had the launch of the CBO, the Chicago Board Options Exchange, and you got a little experience with the CBO and through your OCC and OIC work, right?
Yeah, absolutely. So yeah, options started trading in 1973 on the Chicago Board of Options Exchange, and I believe it was the first day they traded 911 contracts. That was the very first day. Puts weren't even introduced until 1977. It was just call contracts.
So
And
4 years with just calls. Okay.
yeah, it was just calls. So, over the years, the options markets have just grown. The growth and trajectory of options have just been absolutely stunning. I mean, we just set a record last year alone in 2022, where we cleared and settled 10.3 billion contracts, and we had Yeah, we had an average daily volume of 41.1 million contracts. It's just astonishing.
And there's over 3,000, I don't remember the exact number, over 3,000 separate equity issues that are optionable, right?
Yeah, I believe it's even more than that now. I don't have
Yeah,
the
yeah,
exact number, but it's a huge number because they're constantly adding, single stocks are having options listed on them. There's so many
yep,
ETF products that are coming out now
yeah,
that,
yeah,
they're having options listed on them. One thing about listing options, a lot of people think, like, we get questions at OCC all the time that they ask us, well, can you list options on this product? And we always tell people we OCC only clears and settles the options
yeah.
contracts. We don't have anything to do with, what gets listed, what strikes, what durations. That's completely on the exchanges. So that's if anybody has interest in having options listed on a stock, you have to contact your broker or any exchange because they're the ones who oversee all that.
We have indices. We now have options on indices that people can, hedge portfolios or speculate on the markets. What else? What else do you see popularity-wise, even as far as expiration? Because short-dated options now are really coming into their own.
Yeah, it's interesting. So, during COVID, there was a huge uptick in single stock options where people were trading. They weren't working, they were at home. A lot of people just
Yeah,
started day trading. You saw the GameStops and the AMCs and some of these meme
right.
stocks that just made parabolic moves, and there was huge amounts of volume. That's kind of trailed off a little, while the options and the single stocks, they're still rather high. It seems like a lot of interest is gravitated to same day expirations on indexes and ETFs. And a lot of that volume that you see on any given day is really very much concentrated on the same day expiration options that, basically expire at the end of the day. So not only from an institutional standpoint, but also, I believe, from a retail standpoint, that there's a lot more interest in the same day expirations for the ETFs and indexes as opposed to single stock. Single stock is still very popular, but it
Sure.
just seems like there's this, investors are starting to gravitate more to ETFs and indexes, at least over the last, say, 6 months. So,
Well, I remember when I started in trading education, it was kind of taboo. I believe it or not. Of course, this was 20, 25 years ago. It was kind of taboo to talk about options. We all knew they were out there, but
yeah.
the dignified trader doesn't use them. It's kind of that transitional period. And like you say now, retail traders of all stripes are recognizing them for how they may be used, whether it's leverage, speculation, hedging, whatever the case may be. There's all various kinds of strategies. And what's nice, I think, is, as you mentioned, is the products are being offered to keep up with what the appetite is from the trading community.
Absolutely. And, I mean, if you're trading a stock, there's really only two ways to make money on a stock. You can either buy it
Right,
and it goes up and you make money, or you can short it. And if it goes down, you make money. But with
right.
options, you can make money whether a stock goes up, whether a stock goes down, or whether a stock is range bound and does nothing. So it's really, the product is so versatile and useful depending on how you want to apply it based on your forecast and risk tolerance.
Uh-huh.
Once again, leverage, it's a double-edged sword. It's good it's great when it's going your way, and it's really bad when it's going against you. But there are ways that you can creatively structure the product around a portfolio or a stock, to generate income, to protect it against, adverse moves, either up or down, or, position for an earnings event. You can tailor an options position based on any forecast you have for a particular security. And that's the beauty of the product. It's just so versatile. And I
Well,
think, to your point before, where
yeah,
people were, before options, it was kind of a dirty word. Like, people just didn't, I don't trade options. I think it was really because people didn't really understand the product. They just thought,
right.
well, trade options, I'm going to lose a lot of money. But if you understand and how to use the product, they can be extremely useful and give you a lot more options, to coin a
Right.
pun, but they offer you a lot of different options that you can apply to your investing forecast, which you don't necessarily get with just buying and selling individual stocks. So, um, yeah,
I think what we're going to be talking about on March 8th, what people start to understand is that at its core, options is really a transfer of risk, right? You can either be paid to accept risk, or you could pay to transfer risk away from you, and all these various strategies that we talk about are really built from those building blocks.
absolutely.
Well, Ken, listen, this has been a great conversation. I hope that the people watching, I hope you there as the viewer are getting a little bit of interest here now in this thing called options. And I want to now specifically invite you to our options event that will be held on March 8th, and it's an all-day event. We've got various sessions that will take you through different strategies, different understandings of this world of options. But for now, Ken, listen, thanks so much for joining me today.
Absolutely.
Appreciate your thoughts. This has been fun for me. I hope it's been fun for you, the viewer. And we'll look forward to seeing you on March the 8th. I'm Rick Swope for the investor education team here at E-Trade from Morgan Stanley. Thanks for joining me. Look forward to seeing you again real soon. Bye-bye now.